when we're going over data in the news, it doesn't really hit home until you physically see it yourself, outside of just looking on a monitor or computer. And so my wife got a text message seeing a car getting towed from Disney Springs. Now here's the interesting thing. Disney Springs doesn't tow cars. So this means it was a repo. I know we've talked about the consumer running out of cash, but when you start seeing this kind of stuff in your backyard, it definitely makes you start to scratch your head. Is everything really okay? Citi downgrading stocks as it's going to see a pretty big pullback here. This is pretty interesting that Citi's deciding to downgrade stocks right before the banks report. As we all know, capital requirements are changing for the big banks, and who the heck knows what's going to happen with the regional banks, as most of their assets are underwater, and there's a tremendous amount of local commercial real estate that's in question. Are there more skeletons in the closet? So as real earnings kick off right around Thursday of this week, we have some interesting lineups here. Now, most of these are going to be defensive. We all know travel's running hot. Pepsi's fairly defensive. But where it's going to get interesting is going to be the JP Morgan, Citigroup, and Wells Fargo reporting. This is where I think we're going to figure out what the heck is really going on with the banks. And these banks are going to give us an idea of what's going on internally with the depositors and how underwater are some of their assets. Now, these are the banks you probably want to be invested in, but they're still going to give us a good idea of how confident they are going forward into the next couple quarters here, especially with the lag effect of monetary policy. We're also going to get a better understanding of their projected earnings, considering two different things here: the headwind in the consumer and the new requirements that could be coming down the pipe here for the bigger banks. To me, the banks are becoming less interesting as an investment standpoint. A, I think there's a lot of question marks. B, I think the low valuations are now justifiable. With the unknown of bank requirements and deposits going forward, the unknown of the consumer, and the lack of loan creation going over the next 18 months or so, I tend to think banks are really not exciting. But where it does get exciting is if we do go into a recession and they get really cheap, the banks are the ones that are going to be lending out the money as interest rates get lower. We get a booming economy once again. You're definitely going to want to have some financial exposure, but I tend to think staying away from them at this point in time makes a tremendous amount of sense. So Hugh Sun's article here kind of demonstrates exactly what we're talking about. The big banks are going to be well capitalized. We're definitely looking for a seismic shift here in the banking landscape. And we have this balance between fintech companies we think that are fintech, and the old brick and mortar companies. And then you have your regional banks. I feel like, and with the consumer slowing down and debt restructuring taking place, as rising interest rates will deepen losses on securities held by the banks, motivate sellers to pull out from cash accounts, squeezing the main ways that these companies make money. We also have the combination of commercial real estate. This is still a big skeleton in the closet, in my opinion, especially with I definitely think over the next 4 to 5 years, we're going to see this banking landscape really change. Really hard to pick the winners, really hard to tell which regional banks are going to come out of this okay. And Morgan Stanley's Mike Wilson is doubling down. The guy remains bearish, even though most of Wall Street is capitulated and went from bears to bulls. And I tend to agree with Mike Wilson on this. I do think earnings are going to disappoint. And as we're going through deflation, we're going to see some pretty impactful things happen with earnings. Inflation causes asset prices to skyrocket. Deflation is going to do the complete opposite. Not only are asset prices going to come down, but we have a consumer that is starting to dwindle. And so less spending on the consumer, less lending from the banks, asset prices coming down. To me, this is multiple headwinds on earnings season over the next couple quarters to keep an eye on, as I do think earnings have been deteriorating. We've been in an earnings recession, but the market is ignoring all this on 7 different stocks. We'll get that in 1 second here. And so Mike Wilson stating the reason why this rally has taken place is a few different things here. Obviously, the AI boom was one thing, but secondly, earnings weren't as bad as anticipated, but they still are contracting. And he believes that forward guidance still needs to come down and earnings are still contracting, as higher interest rates and dwindling liquidity suggest stock valuations are vulnerable unless companies boost forecasts. So this is why I was saying I think the banks kicking off could really set the tone here. I don't think the banks are going to have great earnings because, as we all know, most depositors are leaving for money market accounts, getting a higher interest rate. We also have to factor in that most of their assets are underwater. On top of that, what are they not doing? They're not lending. So I tend to think the banks kicking off this is going to be an interesting setup for the rest of the market. I think anytime we throw some cute names on a group of stocks that's really carrying the market, it's always good to kind of look outside of these stocks. This means that the coverage is phenomenal, there's perfection priced into these stocks, and there tends to be not a tremendous amount of upside at these levels. Once you start getting the Magnificent Seven, the FANGs, it's too late at this point in time to really be adding to these positions. Now, if you got in early or if you bought big dips, congratulations. I think these are companies you want to hold forever. I wouldn't be putting new money into these new initiatives here. Once you get a new name on a sector, or you get a new name on a group of stocks, they've rallied over 100% at this point in time. Usually best to take profits and or not add any more new money into this. I would just be cautious, because when we start getting these cute names for a group of stocks, usually starts becoming bubble territory. I just want to remind you guys, remember when we had the FANG run for a little while? Well, most of those stocks got completely slashed in half. I'm not saying that's going to happen here, but I'm just saying that a lot of money has already flocked to these stocks. A lot of perfection is priced into these stocks. And if you're jumping in now to be part of the Magnificent Seven, I tend to think your money's going to disappear. And that's the only magnificent act we're going to see. So as earnings start coming out, we'll keep an eye on it, update you as we go, and we will see you in the next one. Peace.